Welcome to the Legatum Institute. My name is Christina O'Donnell. I'm the Director of Communications here. Tonight we are delighted to be hosting this panel discussion on the shadow economy, its impact and innovation east and west. But before I introduce our eminent panel and their moderator, just a few words about the Legatum Institute for those of you who are new to us. We are an international think tank and an educational charity. We want to promote prosperity, and we hope to do so with a host of programs, including our vision of capitalism, which is Tim Montgomery delivering an agenda to the new government, whichever party that may be, on how to restore faith in the free market system. We have Anne Applebaum and Peter Pomerantsev, who are working on our Transitions Forum program, and that is focusing this year on the Russian disinformation campaign and how it threatens us. Sorry, the West. We also have our signature annual publication, which is the Prosperity Index, and it ranks 142 countries in terms of wealth and well-being. Now, over to our panel. They are Giles Andrews, CEO of Zopa, peer-to-peer lending; Tina Fordham, Managing Director of the Global Political Analyst at Citi Research; Peter Sanfey, Deputy Director of Country Strategy and Policy, Office of the Chief Economist, EBRD; Jan Svejnar, okay, founder and chairman of CERGE; and Andrei Kirilenko, professor of the practice of finance at MIT's Sloan School of Management. Moderating them is a man who has championed Eastern Europe for all his life. And ever since, in fact, his first days in Prague, behind the Iron Curtain. His name is Edward Lucas, and he is also the author of the prescient, some would say, bestseller, The New Cold War. Edward, over to you.
Thanks very much. I apologise for giving you the giggles. So I'm a senior editor at The Economist, and I'm also an economist by academic background, although nothing like as distinguished as my fellow panellists. And I think that this is the most interesting bit of economics. It's where economics interacts with the real world. As economists, we like stuff that we can measure and that we can model. And the shadow economy, almost by definition, is really hard to measure and to model. So you have to understand it instead, and that's really interesting. It's about human behaviour, about incentives and disincentives, and what people will do in suboptimal conditions. We had a brief podcast before this where Jan and I were discussing what the real definition of the shadow economy is, and I'm going to turn to him in a moment to kick it off. It seems to me that it's not inherently illegal. There's a very crude definition, which is the shadow economy is the same as the black economy, and that's people doing bad things. If they were caught, they would be fined or arrested or whatever. And I think that is too narrow. We'll be teasing this definition out of it in the course of the panel. There are things that are just too small scale to attract the attention of the taxman, of the regulator, and there are things that are unregulated because they're offshore. For example, the whole idea of shadow banking, which is things like offshore money market funds that are actually working like banks but don't get regulated by banks, with all the interesting systemic risk that implies. There's the whole business of cryptocurrencies, money which isn't really money, it's very complicated sums, such as Bitcoin. We'll be getting onto that as well. So we're going to stretch beyond the simple binary legal and illegal definition of the shadow economy towards these more, I think, subtle and interesting questions. Christina's already introduced the panel once. I won't do that again, but I will give a couple of sort of key points as I'm introducing each person. But I'm first of all going to turn to Jan Svejnar, who, if history had turned a bit differently, would be the President of the Czech Republic, possibly serving a second return instead of the disastrous incumbent that we have at the moment. But we're not here to talk about Russian agents in Eastern Europe, so I'm not going to get onto that. But instead, Jan, you're a professor at Charles University, one of the oldest universities in Europe, and also at Columbia. And you know this subject inside out from both sides of the Iron Curtain over a long period of time. So talk us through your definition of the shadow economy and what we should think of it.
Well, you've pretty much defined it, but let's just start with the fact that it's so difficult to measure, in part because it's so difficult to define. Right? It really is a set of activities. If you try to give a very shorthand definition, one way or another they escape government reach, government regulation. So they may be criminal activities at one extreme, they escape government regulation and the norms that the society accepts, all the way to informal type activities like household help that may not be illegal, may be illegal depending on some definitions. So you have a whole spectrum in terms of where it is located, which sectors of the economy, sometimes outside of a given sector. The shadow banking example is a good one. It sort of goes global in many respects. And indeed, when you look at the measurements, this is not where people debate whether it's 10 or 15% of GDP or of the economy. I mean, the magnitudes are, is it 5% or 25 or 30%? So as you can see, reasonable experts differ tremendously in terms of how big the scope of this is. I think that what's fruitful after debating, what really belongs and what doesn't in some sense belong into this paradigm of activities is what is beneficial and what is not beneficial, where the government should intervene and where it shouldn't intervene and under what circumstances. And I'll just, to start the discussion, I'll give you an example. You will have a consulting firm which is very productive, high value added, profitable, and people may try to escape taxation by not reporting everything that they are doing, right? So most of us would agree that this is an undesirable outcome, something that the society and the government should be worried about and do something about. Take a starting entrepreneur or a small household that's trying to make it, take in particular a poor country, where they're productive, they're adding value, but very little. Right? They're basically at subsistence, and if you tax them, you'll force them out. Right? At which point they will be having zero productivity. Right? They will add nothing to the economy. And in more advanced countries, will have to be paid unemployment benefits and so on and so forth. Right? Now there one can sort of argue, look, giving them a chance to actually stay and learn and maybe become productive over time is in the social interest. And therefore the government should not, in a hurried way, unpremeditated way, intervene and extinguish this type of activity, some of which may be the kind of entrepreneurs who later become big entrepreneurs and add lots of value, innovators, inventors, and so on. So I think I would gear the discussion in this direction, and then the measurement should proceed accordingly, in the sense to figure out really, which part of it we want to focus on, which part we want to leave. And in our discussion earlier, I gave an example which for me is really fascinating. I was in Vietnam a few years ago and had a guide, individual, who basically said, look, those of us who are small entrepreneurs like I am, the government lets us go without taxing. They know about us, they will get us when we become bigger. But here was a communist government, reform communist government, however you want to call it, that actually understood that it's good to have these people try to make it. And once they made it, then we tax them. Right? So interesting insight. So.
Well, thanks very much, Jan, for kicking us off. I think it's true in most developed economies there is quite a lot of latitude for micro businesses. I mean, here in this country, you don't pay VAT until a certain level. You don't have to pay business rates until a certain level, and that's perhaps an example of the right way to do it. But I want to turn now to Peter Sanfey, who is at the EBRD, which, as you all know, is the development bank which has been concentrating for the last 25 years almost now of helping the former captive nations, as we co-warriors call them, of Eastern Europe, catch up on the economic and other development that they missed while they were stuck behind the Iron Curtain. And what really strikes me about that is that until communism came down, black marketeers were economic freedom fighters. They were regarded as real heroes. This was a very, very good thing to do. You were Of course they're breaking the law. The laws were bad, and that was a good thing to do, and bring down the evil empire by selling black market cigarettes or whatever it was. And then we had to do a kind of screeching handbrake turn in 1989 to 91, saying, actually, laws are quite good things. We need to obey the law. You need to pay your taxes and so on. And that's worked extremely well in some countries and extremely badly in others. And I'd be very interested in hearing from you, your EBRD perspective on what the right way to deal with the shadow shadow economy is in these so-called transition economies of Eastern Europe.
Well, thank you very much, Ed. I think the first thing to say is that the shadow economy is absolutely pervasive throughout the region that we operate in. And Jan has alluded to the difficulties of measuring the size of the shadow or informal economy, but typically we think of it as being about 1/3 of GDP in many of our countries, and quite a bit bigger in quite a few of them. So it's prevalent, and it's something we as an institution have to deal with on a day-to-day basis in terms of finding clients we can work with and trying to ensure that our clients are working legitimately in the formal and not in the informal economy. I think there are three things I wanted to say about the informal economy in the transition region. One is I think it's a serious problem for the individuals who work in the informal economy. I know it can be a source of poverty alleviation, it can be quite flexible and so on, but the fact is that people who work in the informal economy are typically paid less, they work in sectors with higher inequality, and they tend to be less happy as well. In general, they would like to be working in the formal economy. So for individuals, it's not really a good deal. Now, the second point is when it comes to businesses, we know from big surveys that we in the World Bank do periodically in the region that legitimate businesses are very concerned about competition from the informal economy. In fact, the last time we did this survey a couple of years ago across the whole transition region, we found this was the #1 complaint of businesses. It's an even bigger problem than things like access to finance or corruption or tax administration and so on. Competition from the informal sector, because these people are getting away with not paying taxes, social security contributions and so on, not being subject to the same degree of inspections and the like, and that is a big problem. And the third point I wanted to make on this is that when it comes to innovation, we have just published a few months ago our latest transition report, which had a focus on innovation. And the point of this report was to highlight the importance of innovation as a driver of productivity and growth. And the innovators, when you talk to them, they complain even more than non-innovators about problems like competition from the informal sector. So I think it's a very serious problem, even now, nearly 25 years after the start of transition. It was and it remains a very serious problem for the transition region. And I hope we can come up with some innovative solutions tonight to address the problem.
Well, thanks very much for that, Peter, and particularly for this point about the kind of black competition, as I think it's sometimes called. I don't know if there's anyone here from Lithuania, but there was a very interesting example in Lithuania where you had one supermarket chain which was trying to do everything by the book, and its main competitor had, I think, what might be charitably described as excellent relations with certain parts of government, which meant that it had a completely different tax and customs regime. This is before Lithuania joined the EU, and it was really suffocating. This reputable chain, which didn't know whether it should try and adopt the same tactics or complain like mad and hope that the law would be enforced. But that takes us very neatly on to Tino, who I think has probably got one of the best jobs in the world, actually, being a political scientist paid by an investment bank to find out what's going on, think about it, and draw conclusions. But let's get into the way. What does this tell us about the way politicians should design laws, build institutions, and make the societies run in a way that allows this sort of beneficial innovation, small-scale entrepreneurship without distorting the whole economy and giving the black side of the economy an unfair advantage?
Well, it'd be wonderful if it were just a matter of writing laws, but as we know, many of these countries have great laws on the books, but they're not implemented. I'm here, obviously, in my capacity as Citigroup's chief global political analyst, but I come with 25 years of experience in this part of the world, and the comments made earlier really brought back a lot of memories of being at the School of International and Public Affairs at Columbia, studying these transitions, and in many ways, how little progress has been made. Why is that? Well, if you look at the kinds of indicators that we would try to evaluate to assess what is likely to lead to a large informal economy, it's the usual suspects. Growth or lack of growth. This is tied to the economic cycle, and we are in a weak cycle in Europe generally, and particularly in southeastern Europe. So it might be that we would expect to see more activity in the informal economy. Levels of development, and of course as a political scientist I'm quite interested in institutions and governance, quality of administration systems as well. Are there ways to pay people that work? In the absence of robust growth and sound institutions, the informal economy will have the conditions to flourish. That affects all kinds of things. It certainly affects growth. It affects investor perception. As you were saying, you have trouble finding entities that you could invest in because of the lack of regularization, if you will. In my role, though, and something I've written about a lot, which I call Vox Populi risk, I think it feeds into the more generalized angst. It's not just in this part of the world, it's across Europe, of course, where a lack of trust in politicians, in fact in elites generally, political and business elites, really reduces the willingness to pay tax, right? And I think in some ways we might look a bit at Greece to think about how this can go very wrong, even within a European Union member state, where the sense of collusion between the mainstream parties, very low rates of willingness to pay tax, has really, leading to a potential tipping point in a country. The countries of East Central Europe, Southeastern Europe remain very fragile. If we're going to talk about what governments can do, well, governments need political capital if they're going to reform. And it's hard to see very many governments in the region that really have the political capital, meaning the votes in parliament and the support to make big changes. Across Europe, after all, look at our own cases here in Western Europe, we have muddling through and a real difficulty in making reform. I would pose some other questions to the group and to the panel. Have many of these countries hit a middle income trap of sorts?
Can you just explain? I guess half the people in the audience know exactly what a middle income trap is and think about it all the time, and another half probably have no idea what you're talking about. Just unpick middle income.
Have they maxed out? Have they grown as much as they are likely to without another set of big innovation, competitiveness, some other change in these factors? I also have been thinking about a north-south divide emerging in East Central Europe, right, where Poland and the Baltic states are doing well and significantly better than the southeastern European states. Trends that as we see them now, not just in the region but elsewhere, suggest that this divergence will only get worse. Could EU subsidies be making this problem worse? Very, very possibly, and feeding into this middle income trap, meaning there's no incentive to try to do more, to be more innovative and to grow other entities. On the idea of the fragility, we don't want to go down this route yet, but I think that both the possibility of Greek exit and the reemergence of Russia as an actor in the region in a new form is only likely to increase the risk of political fragmentation and make the likelihood of cohesive governments with the capacity to reform that much more reduced.
That's really interesting, particularly I think this idea of that you get stuck in a sort of highly suboptimal but quite stable equilibrium where people think that theoretically it would be nice if this country was run like Norway, but actually it's never going to be run like Norway, so I'll carry on doing my own maybe not very high value added, rather corrupt, but predictable sort of business and lifestyle with low expectations from the state and very low engagement with it. And I'm not sure there are any examples of countries that really bounced out of that once they get stuck in it. Is there an example of a country that's been in the middle income trap and then got out?
The trouble with these countries is that they have some of the worst problems of Western Europe in terms of poor demographics, and then they have the emerging, kind of emerging economy problems at the very same time. So I think that they are in a particularly tough spot. Other countries that have gotten out of this have commodity cycle booms and
yes.
other developments which support them.
So dig for oil. Not sure even that's worked very well for Russia. But now, it strikes me we've all talked so far about what one might loosely call the old economy. We haven't talked about technology. So I want to turn to Andre now, because your academic specialism is the intersection between finance, technology and regulation. And it seems to me that the internet, with the death of distance, the ability to store value in terms of electrons on a chip, or even in the cloud, is really divorcing the process of value creation away from these old territorial boundaries into something quite new. So what does that mean for the shadow economy?
Right. So thank you. My sort of definition and focus on the shadow economy is maybe quite a bit different from the shadow economy where you have a taxi driver operating without a license. So my sort of thought of the shadow economy is something that operates more on the global scale and something that you can enter and exit. And since the conversation here is how the shadow economy was affected by the financial crisis, one of the probably most important developments that happened right at I would say one of the most hardest moments of the financial crisis in December 2008, a anonymous person or a group of people going under the alias Satoshi Nakamoto published a piece on the web where they described a peer-to-peer payment system. So current payment system, even though it's automated, it runs on the sort of hierarchical structure based on intermediaries, based on banks, based on central clearing counterparties. And it costs sort of the estimate about $2 trillion to support that network.
That's the existing financial system?
Existing financial payment system, yeah. Just payment system, just to send payments around. So all of your activities, whatever it is that you're trying to do, have a payment surrounding them. So you have normal cycle of economic activities, and you participate in the modern economy by exchanging it and engage in sort of a set of payments. Ideally, you'd like this payment system to be peer-to-peer, but the peer-to-peer has the problem of sort of lack of trust in each other. So the way it has been solved traditionally is that centralized intermediaries were developed, third-party intermediaries, and there was a central authorities that were supposed to establish this trust. During the financial crisis, there was a loss of trust in the central authorities and in that system. There were insurance companies that positioned themselves in the middle of what I would call shadow economy of over-the-counter derivatives. And I spent 2 years at the Commodity Futures Trading Commission as a chief economist, writing cost-benefit analysis, figuring out how we could take this OTC world out into the exchange, lit trading. So you can sell that, you can say that this is, to me, coming out of the shadow and into the formal system. And the technology plays a role here. With this new payment system, which is called Bitcoin, some of you have heard that word before, it's really quite revolutionary. It's an amazing system, and what it does is that it recreates the way that the payment system is done from this sort of distributed from this hierarchical system in which you have to have trust in someone, into something where you have a trust in the formula. You have a trust in technology, and this is one of the things where, especially with application to the part of the region that was being discussed here, Central Eastern Europe, partly Western Europe, is sometimes trust gets developed in the process, in the formula, rather than in particular individuals or institutions that are operating it. So that is sort of the intersection of how something that is shadow could be thought of as existing because of trust in as you said, there's trust in the political system. There's a lack of trust in the political system. There's a lack of trust in institutions. There's a lack of trust in how the central bank conducts itself. And then technology comes and establishes something that could be used, mobile phone systems. People believe in ability to use mobile phones regardless of whether or not they have a good, set of laws or not, right? And it replaces in some way and torpedoes this old structures that we've sort of traditionally developed and automated, but then had to rethink.
So what is happening is that technology is evolving to make up for the trust gap. People don't trust the existing financial system to do the job properly, either because they think it's overpriced, or maybe they think it's too risky, or they're worried about government intrusion. And so they're turning technology now allows you to do your banking, in effect, make your payments through very complicated maths, which you don't need to understand. You just have to believe that it'll work. Right, that's good. I think I've understood. I think I've understood that. I've said I had a Bitcoin once, and I lost it. It was very annoying. It was on a computer which I wiped, and I was unable to get the Bitcoin back again. But
that could happen to your actual currency too.
Yeah, exactly. Yes, but it
often does.
It was the equivalent of losing £1 down the back of a sofa, but £1 that later turned out to be worth several £100s. But I'm going to turn to Giles now, because you have actually run. It's Britain's biggest and the world's first peer-to-peer lender. For people who don't know what peer-to-peer lending is, it's the idea of it's banking without banks. You borrow and you invest, but you don't have a bank in the middle that takes the risk. The risk is spread into tiny little chunks among all the people who are taking part. I have to declare an interest. I have some money in Zopa, and it's a very good system, because if they can't lend it out for you, they pay you £1 a day, which is not something I've had from my NatWest account, I can tell you. So from an enthusiastic customer, Giles, the floor is yours.
Thank you. I don't know whether I should feel more a sense of intimidation as a simple entrepreneur surrounded by such distinguished academics, or a sense of outrage that I'm being asked to describe my incredibly respectable business in the context of some kind of shadow economy. So I thought I'd just talk a little bit about some of the principles on which we founded Zopa and why we did, and what inspired us. So Zopa, broadly speaking, was inspired by the bond market. So in the 1950s, 1960s, the bond market evolved and became the place where all large corporations went to issue debt or borrow money, in old language. So large companies stopped going to banks. Why did they do that? Because they found the market more efficient and offered them better value. So we asked ourselves whether or not similar market conditions could be created, such as we could create a bond market for consumers. So what do you need for a market like a bond market to work? Well, you need data that's trusted. So in the case of the bond market, obviously, Moody's, Standard & Poor's, who may have a bad reputation for rating books of subprime mortgage securities, but no one's ever criticised them for rating General Electric or Boeing. So allowing investors to make informed decisions about risk. You also need a pool of investors who are looking for the kind of return that the market would offer. And in the bond market, that's self-evident, because trillions of dollars are traded on the market by people who are looking for a return that typically sits somewhere between the return paid by central banks on cash and the return that companies generate in equity return. A less volatile, more stable return than equities offer, and a higher return than cash. So we figured that trusted third party did exist on consumers. It wasn't quite like a bond market. I might not lend £10,000, no offence intended to anyone in this room, but I might happily lend £10 to 1,000 people who look like you. And as Ed says, working on the principle of diversification and sort of splitting up people's lending into very small units, that data works extremely well and very, very predictably on a portfolio basis. The other requirement for the market was a pool of investors who are looking for a better return than paid by banks, in this case, retail banks paying their consumers as opposed to central banks paying bond market traders, and a safer return than offered by equities. And we built the product for the man in the street, because the man on the street has access to very few financial products. We typically can buy our own house. Some people own more than one, but not many. The buy-to-let phenomenon, in terms of the numbers of people doing it, is actually surprisingly small. And people in this country, and we built the business for this country, we're a UK-only business, don't have a great propensity to invest in equities. Wealthy people have all sorts of weird and wonderful things to do with their money, most of which don't make them money, but they're sold lots of weird and wonderful products. But the man on the street has very little that he or she can do with his money. So Zopa was built to offer a better return to the man on the street and a better value borrowing product for those people who effectively are going into a marketplace to issue debt in themselves. Now, the interesting point is when we start getting into the area of trust and regulation, and we were incredibly lucky, all businesses need a bit of luck. We were incredibly lucky to launch a business 2 or 3 years before the credit crisis, and to have built up a good track record in managing risk at a time when, frankly, bankers were not doing quite such a good job. And then when the crisis evolved and trust evaporated, we were able to capitalise upon that, and the business has really gone from strength to strength. And from a regulatory point of view, one of the strengths of our business is it's fundamentally stable. So I agree to lend money. I agree to lend money for a period of time, the same period of time that a borrower wishes to borrow it for. So I'm not creating a sort of borrowing short, lending long systemic risk that actually Western banking has adopted wholesale, forgive the pun. So actually the fundamental system of our business is more stable than banking. And that's attracted fans as diverse as Andy Haldane of the Bank of England, who described peer-to-peer lending as a genuine alternative to banks. And it's meant that from a regulatory point of view, we're not under the scrutiny of the sort of systemic risk regulators. And indeed, we've been campaigning for many years to be under the supervision of the conduct side of regulation, because there is a risk, and this is back perhaps where we do get into the shadow economy debate. If a business like ours was operated badly, irresponsibly, or nefariously, absent regulation to protect consumers, then that could lead to consumer detriment. So we've welcomed the fact that the regulators engaged with us and built us our own bespoke regulatory regime on the conduct side.
Very interesting question. There are people who can't borrow in this country who don't have access to conventional finance, and that they are some of the most put upon consumers because they end up with these completely unregulated doorstep lenders. Do you think that peer-to-peer, there are other peer-to-peer lenders in Europe who specialise in catering for that market? Do you see a way for peer-to-peer to push into the shadow economy and offer a better deal than the doorstep lenders?
I think that's really challenging, because I think if you go back to my requirements for a stable and efficient marketplace to evolve, one of those is trusted third-party data. And the problem with people who borrow in the shadow economy is there simply isn't enough data on those people to make informed decisions. That doesn't mean people don't try, but I'm very nervous, and we've had this conversation before. I'm very nervous of a belief that there is a better way to lend to those people. Ultimately, the most powerful credit data on those people is held by their community. And I think you've seen evidence of microfinance businesses leveraging the power of a community. But as soon as you go beyond the power of the community and you go into the world of strangers, then I think you introduce all sorts of risk. And I don't think I'd be doing my lenders a service by effectively encouraging them to gamble on an unpredictable return.
Super. We've got plenty of topics for the discussion. I just wonder if anyone wants to come back on any of those points. Jan, what did you make of the point about technology acting as a sort of an accelerant for the planning economy? I mean, technology has obviously made Bitcoin possible. It's also made your business possible. You couldn't have done this in the pre-internet.
We couldn't have done it in a widely distributed manner.
So
I think it's a remarkable thing that we've gone through an incredible technological revolution over the last few decades, and it has had sort of visible effects in the regular type economy, and obviously has pushed these new types of economic activity that can be extremely beneficial and have been harnessed by these entrepreneurs. I would add one more aspect which I think is related to all this, and especially in the region, Central Eastern Europe, further east, further south, is the notion of corruption. We've kind of been dancing around it, but I think it's tied to the shadow economy in the sense that to the extent you have corruption, the people naturally don't want it to be visible, right? So all this defrauding that goes through corruption, etc., and sometimes on a very large scale, has actually created a shadow economy in these countries that one was not fully aware of. And it goes back to the question of the rule of law. On the books may be very good, but in the terms of the enforcement, very weak in many of these countries. And it's coming to the forefront even more, I think, recently, and brings another dimension to this.
And of course, Peter, we always have to remember a bribe requires two sides, someone to give it and someone to take it. And it seems to me that in a lot of countries, officials have a vested interest in keeping the shadow economy going. They actually want regulation to be bad, because then if the regulation is impossibly burdensome, nobody knows what the law really says, nobody has confidence in how it's going to be implemented, the rational thing then to do is to go underground and pay a bribe.
Absolutely, and in fact, what we found is that there is a belief in some countries that a bit of corruption kind of greases the wheels, that you can actually get things done by a bit of corruption. And that, I think, is one of the biggest challenges that we face in trying to operate in these countries. Somebody mentioned the point earlier about a kind of equilibrium. I think it was you, actually, Ed, about countries getting stuck in an equilibrium where everyone is recognizing that by changing their own behavior, they believe they can't change things. It needs everyone in a coordinated way to change, and that's really the challenging part of getting out of a bad equilibrium where everyone is, or
Equally
huge
unhappy.
numbers are equally unhappy and equally, contributing to this informal economy, which, as Jan is saying, is very much tied in with corruption. How to get from there to a much better equilibrium.
I would take it further. I would say that there is, in many cases, a huge disincentive for governments to dismantle that bureaucracy because it reduces the opportunity for rent seeking. So if you look at the countries that have been the top performers on the World Bank Index, like Georgia, they tend to be very small because it's quite difficult to do. Reducing corruption is something that governments talk a lot about. But the most common mechanism for it is through bureaucracy. That's why the World Bank indicators measure how many steps to do things like open a business, because each one of those steps is another opportunity to pay or receive a bribe.
When you mentioned Georgia, it reminded me, I see we have some really big experts in Georgia in the audience. In fact, lots of other experts as well. And I'm going to come to come to take some points from the floor in a moment, so please start polishing your remarks. I'm happy to have both questions to the panel and statements. We've got some expertise here. It'd be very useful to tap. But I want, Tina, just to ask you about we talked about technology, but it seems to me that the other accelerant is globalization, that you can do your business now across borders or in other countries. You're not necessarily subject to your own national regulation. If you don't like the way things work in your country, will you register the company somewhere else? You can have e-citizenship, you can have an offshore company, you can register in a friendly jurisdiction and do everything with the legal persona of the company there, and just not declare anything and say, well, there's nothing happening in the country, I just happen to live in.
It's a career-ending question, Ed.
That's why, I'm sure, obviously, Citi encourages everybody to pay the maximum amount of tax possible at every point.
Let me address it this way. First of all, in an environment where corruption and perceptions of elite corruption are a threat to governments around the world, whether it's MPs expensing duck houses in the UK, or bigger accusations elsewhere, Yanukovych and his palace, the impetus to crack down on corruption and to encourage tax paying is I think only going to increase. So I'm not sure that globalization is going to help people in that way. It's certainly true that in cases where there's very little infrastructure, very few opportunities, you can leapfrog over the absence of those things with mobile banking, for example. What people can do with mobile phones is very well known in Africa. Certainly, I'm not here representing Citi Business. I'm a research person, but that's been a huge source of growth to allow people to make payments and to borrow money and everything else just with a phone, because they're hundreds of miles from a branch. So technology can help in that way. I am skeptical, I suppose, of the transformative power of technology in economies like this, partly because you have pretty low human capital, which is crucial. We can look at other cases where this exists in Western Europe. Portugal and Spain historically undereducated their populations because they were in the midst of a construction boom. I think East Central Europe and Southeastern Europe are able to export their labor problem thanks to labor migration laws. And it's expensive to invest in education. And these are, again, aging populations. Again, just to think about it in our current context, baby boomers and aging populations demand the social safety net and pension benefits and everything else. There's less to invest in education and innovation and competitiveness in Western and Eastern Europe.
I think the World Bank did a study called From Red to Grey about this absolutely terrifying prospect. Particularly, I think Bulgaria and Georgia were in the worst category of these countries getting old before they get rich, and being stuck with basically rich country pension systems, but poor country economies to pay for them. And on that cheerful note, let's turn to the audience. And I now have to count up to 5, I think, because something's going to happen with the pod. But I'm going to first of all thank I think this bit is not going to be live streamed, that's why. So I'm going to thank at this point Jan Svejnar from Columbia and Charles University, Peter Sanfey from the EBRD, Tina Fordham from Citi, Andrei Kirilenko from MIT, and Giles Andrews from Zopa. And on that note, say goodbye to our listeners and viewers around the world. And thank you very much indeed for watching.